Welcome to the Sykes & Company PA video blog.
The inventory issues in a pharmacy are very crucial to what the income statement or the profit and loss statement is going to show, as well as your cash flow. And let me explain. Obviously, the level of your inventory in a pharmacy, up or down, is going to increase your cost of goods sold section on your profit and loss statement, up or down. So as your inventory goes up, essentially your cost of goods sold go down, your gross profit goes up, your net income pre-tax goes up. And conversely, as your inventory goes down, your gross profit typically is adjusted upward. Your gross margin goes down, your profit goes down. So it's inversely related, essentially, as far as the adjustment on your inventory to your profit and loss statement. Now, obviously, the key item there that you're trying to monitor correctly on an accrual basis is your gross margin. Your gross margin is the single most important number on your profit and loss statement because it gives you an indication of what you're doing net behind the bench with respect to your adjudication of claims and net of rebates, but you've got to take rebates into consideration in determining your net gross profit. Your cost of goods sold, i.e. your inventory levels, are dramatically important in making sure this number is as accurate as possible. The pharmacies that are able to maintain a high degree of quality, both on the balance sheet and the P&L, typically will have perpetual inventory systems with their script management systems are built into those, where they're downloading on a daily or a continuous basis from their wholesaler the acquisition cost information to keep this information as up to date as possible, therefore giving them the gross margin that is important. Now, the level of inventory that you have and the number of turns that you have in a calendar year, which is typically called inventory turnover, gives you a really good idea of the amount of cash that you have tied up on the shelf at any one particular point in time. Now, the industry average is about 11 to 12 turns a year, but we have a lot of clients that are using some cloud-based tools to allow them to optimize this inventory even further, to increase those inventory turns dramatically. In fact, we have some clients with inventory turns in excess of 20 times a year. And if you think about it just a minute, while you certainly don't want to run out of an item on your shelf, especially the more important items that you maybe adjudicate behind the bench, you have next day ordering of most items for purchase from your wholesalers or your secondary wholesalers. And so why would you want to keep on your shelf what you don't necessarily need to have, especially if you're into adherence and stigmatization programs, which allow you to perhaps sync maybe a majority of your clients' fills 1 or 2 or 3 or 4 days a month. You can obviously optimize the inventory turns and the amount of inventory that you have tied up in that inventory count, which again turns to the amount of cash that you're using, which would be the third item that's critical in making sure that those inventory turns are optimized. So if those inventory returns are optimized, you're optimizing the cash that you've got. And as you know, cash that you use to purchase inventory, they're not the Andrew Jacksons that we think about. They're the Benjamin Franklins. Inventory in a pharmacy is not inexpensive, it's expensive. So the quicker you can turn those items, the more often that you turn your items on the shelf, the more often you order yet have what you need to have in place, especially if you're doing synchronization. And if you're not doing synchronization, you need to dramatically consider this because this will potentially alter the work hours of your employees, potentially pay to employees, and your labor, obviously after your gross margin, is the second most important thing that you've got there. So obviously the items are your gross margin, the perpetual inventory system, the turnovers of your inventory that you have on an ongoing continuous basis during the course of a calendar year, and obviously the cash impact of all this as it comes into play in the entire process. So those would be the most important items that one has to take into consideration in optimizing the inventory levels in a retail pharmacy. Pharmacies do have a minor effect with respect to the cost of goods sold items. While they may be locked into a contract with a particular wholesaler, a lot of times there are secondary wholesalers that they can use to provide, whether it's generic items or even brand items at differing prices. That said, if they're locked into a contract with a wholesaler, you got to be very careful that you're adhering to the contractual terms of that agreement. But you do have certainly amount of control, if not ultimate control. Just be careful with these contracts that you're signed that are multi-year, making sure you totally understand what you're signing your name onto these documents as you commit to a wholesaler.
Thank you for watching. If you enjoyed the video, we invite you to subscribe to our YouTube channel.